Are you a real estate investor looking to maximize your profits and minimize taxes? Enter the 1031 exchange, a powerful tool that allows you to defer capital gains taxes when swapping investment properties. Today, I'll demystify common misconceptions about 1031 exchanges between fact and myth. First up is reinventing rules. I only need to invest my cash or only need to reinvest my gain. This is false. In a 1031 exchange, it's essential to reinvest all proceeds from the sale of your property, not just the cash or profit. This means buying a new, like-kind property with a value equal to or greater than the one sold, including replacing any debt from the original property. If you don't reinvest all the proceeds, or if the new property is worth less than the remaining funds, known as the boot, this may be taxable. This could lead to a partial exchange rather than a full tax deferral. Next is replacing debt. I've paid off my loan at the closing of my relinquished property, and now I don't have any more debt to replace. This is false. To achieve full tax deferral in the 1031 exchange, you must replace any debt paid off from the sale of the original property. This doesn't necessarily mean taking on new debt. You can use cash, seller financing, or other funding sources to cover the value. The key is to ensure that the total investment in the new property, including both equity and any replaced debt, matches or exceeds the value of the sold property. This helps maintain and benefits the exchange without triggering taxable gains. Another misconception is vacation home qualification. I have never rented out my vacation home that my family and friends use regularly. It qualifies for a 1031 exchange since it's an investment property. This is false. For a property to qualify for a 1031 exchange, it must be held for investment purposes or used in a trade or business. If a vacation home is never leased and is used regularly for personal purposes, it doesn't qualify as an investment property. The IRS requires that the properties in a 1031 exchange be primarily for investment or productive business use, not personal use. To potentially qualify a vacation home, you would need to lease it and limit personal uses to meet IRS criteria. Next is partnerships. A partnership is able to sell an investment property, and each partner can do their own 1031 exchange with their portion of the proceeds. This is false. The IRS does not allow the exchange of partnership interests under Section 1031. This means that individual partners can't set up separate individual 1031 exchanges based on their share of partnership property. However, with advanced planning using strategies such as drop and swap, each partner may be able to set up their own 1031 exchange. Given the complexities involved, I strongly advise planning ahead by consulting with your tax advisor. Another one is about related parties. I can sell my current investment property to a family member or purchase new property from a family member and have a successful 1031 exchange. Now, this one depends. You can conduct a 1031 exchange involving family members, but there are strict IRS rules to follow. The IRS closely examines these transactions to prevent abuse such as basis shifting, which involves manipulating the tax basis of properties. While it's possible to complete a 1031 exchange with family members, it requires careful planning and strict adherence to IRS regulations to avoid disqualification and unexpected tax liabilities. Next is exchange funds. After I begin my 1031 exchange, I can cancel at any time and request that the 1031 qualified intermediary return my funds. This is false. The tax code doesn't allow a taxpayer to cancel a 1031 exchange at any time. There are specific restrictions on when you can access funds depending on the stage of the exchange. The G6 rules under Section 1031 outline when and how you can receive your money back if the exchange falls through. It's crucial to review these rules when deciding to structure your sale as a 1031 exchange to ensure compliance and avoid unexpected tax consequences. Next, tax deferral. I never have to pay taxes on 1031 exchange. This is false. Section 1031 of the tax code allows for deferral, not elimination, of taxes on the sale of investment properties. When you eventually sell your replacement property without another 1031 exchange, you'll owe the deferred taxes. Additionally, any depreciation deductions you've taken will be recaptured and taxed. However, if you hold the property until death, your heirs may benefit from a step up in basis, potentially eliminating most or all of the capital gains taxes they would otherwise owe. Another one is holding periods. I can sell a property acquired in a 1031 exchange at any time after my exchange. This is another one that depends. The IRS doesn't specify a minimum holding period for a replacement property in a 1031 exchange. However, selling the property too quickly might question your intent to hold it for an investment purpose, which is necessary for the exchange to qualify. Tax professionals generally suggest holding the property for at least 1 to 2 years to demonstrate this intent. In some cases, a shorter holding period may be acceptable, but it's best to consult with your tax advisor before listing the property to ensure compliance and maintain the tax-deferred status. Next, we have ID deadlines and timing rules. The 45th day is flexible. This is false. The 45-day rule in a 1031 exchange requires taxpayers to identify potential replacement properties within 45 days of selling their relinquished property. This deadline is strict, with no extensions allowed unless granted by the IRS due to disasters. Failure to comply with this rule will disqualify the exchange, resulting in the payment of deferred taxes. It's crucial to adhere to these guidelines to ensure the tax benefits of the 1031 exchange are preserved. The last one is reverse exchanges. If I need to set up my 1031 as a reverse exchange, it will be relatively easy to obtain financing. This is false. A reverse exchange allows a taxpayer to acquire new replacement property before selling the relinquished property, still deferring taxes on the proceeds. Though permitted by the IRS, reverse exchanges are more complex than traditional 1031 exchanges and pose unique challenges, particularly in securing financing. Lenders might impose stricter terms, such as higher down payments or less favorable loan conditions, and you may need to work with specialized lenders familiar with 1031 exchanges. It's crucial to consult with tax professionals before signing any contracts if you're considering a reverse exchange. And that's it. Remember, understanding these key rules is crucial for maximizing benefits and avoiding pitfalls. Consulting with tax professionals and planning carefully ensures a smooth process and successful tax deferral. For more detailed guidance, always seek expert advice tailored to your specific situation. If you have any questions about San Antonio or real estate investing in general, feel free to drop a comment, send me an email, or give me a call. I'm happy to help in any way I can.